Hey everybody, we're back with you with the commodity report with Kevin Green every week, and we have a great guest today, which is Patrick. Patrick from Gas Buddy Data. He's been putting out great research for years. Amazing forecast, great feel for what's going on in the overall U.S. market all the time. So, Patrick, excited to have you here. Can you give a guest who might not know who you are, like a little bit of background on yourself?
Sure. Well, great to be here. Thanks for having me on. My background, I've been analyzing downstream markets, generally more focused on gasoline, since that's probably the biggest commodity we use here in the States, but also refined products like diesel, jet fuel. We keep an eye on refineries. Obviously, without refineries, we have none of that. So, oil markets broadly, obviously, we need to know what OPEC's doing or what they're not doing as well. So there's a lot of things. And now here, the last couple of years, a lot of geopolitical issues as well to navigate. So I try to put on a geopolitical hat every once in a while. I'm probably pretty bad at it. So all of that mixed together is what we do. We put out gas price forecasts and diesel forecasts at the start of every year. So, and Gas Buddy's a price tracking website where people report prices to us during normal days. That's helpful to find the cheapest gas in your neighborhood. And during times of outage, we also turn into a fuel availability tracking website. We have a lot of data on demand and prices as well. So good to be with you.
Yeah, I mean, it's interesting because I used to have a transportation business, so we had truck and trailers, and we were always moving around with our equipment, and so we would be using this app all the time to kind of find areas where we needed to go to get fuel cheaply. I mean, we'd be in Louisiana, we'd be in Texas, we'd be in random areas, so it was always really helpful. So. But yeah, so hopping into it, right now, what are you seeing? You have a forecast that's kind of talking about where you generally think gas prices are headed. And so right now, the easiest question to start with is where do you think gas prices are actually headed and how are they looking overall in the United States?
Yeah, I mean, right now, overall, they're looking, fairly decent. A lot of Americans don't like the inflation word has become a really dirty, politicized word here over the last couple of years, right? Because inflation has been pretty hot lately. We're at a pretty normal spot, though. Nominally, we feel a little higher. The national average in the U.S. about 341 for a gallon of gasoline. Diesel just dropped to its lowest level in over 900 days. The average for diesel is now 371. So we've kind of gotten over some of these post-COVID, wacky prices. Russia's invasion of Ukraine still having somewhat of an impact on prices, but things have been cooling off lately. And a lot of that because the Federal Reserve has really ramped up interest rates, which have slowed the pace of the economy. But interesting time to talk with you here today because there's been just a spat of economic news, right? The stock market's been a little bit all over the map. The volatility indexes have been off the chart because of how this economic news could have an impact on the broader economy. So you get a really bad unemployment report, a good jobs report, right? It's kind of conflicting data. So where we're going with that is oil prices have been a little bit all over the map lately. And we also have OPEC and Middle East tensions. And again, Iran and Israel, Hamas, Hezbollah, all, having somewhat of an impact on where oil is for now, and OPEC's production cuts. So, there's a lot going into it and keep an eye on. But for now, prices have basically kind of normalized, if you will. National average at 341. And where I was going is if you adjust for the increase in wages, that's actually spot on where we were in 2018 when the national average was in the 280s. So 280s back in 2018 is essentially the same thing as 340 today. But nostalgia is a heck of a drug, right? Everyone really loves to see those $1 and $2 prices. So from then, obviously, it starts with a 3. We're not at 299, but I think most Americans would probably say gas prices still a little elevated.
So Patrick, you brought up diesel. So let's just nerd into this real quick. So diesel prices obviously have been coming to the downside. We know that, I call it the recession for transport companies themselves, recession for intermodal freight. And that's been around for about a year and a half. And we know that our production levels here in the United States have actually been pretty healthy. If you take the EIA estimates at face value, which we don't, for the most part, we have to until we get the monthly revisions. And it seems like they're changing their mix from heating oil and distillates to gasoline a little bit more, which should alleviate some of those prices. But what are some of the signs that you see that maybe we are having a bottoming when it comes to diesel? Do you think this is kind of the short-term bottom for now, just based on the production mix and then based on prices? Or do you think we have more room to run given the economic headwinds that we're seeing not only here in the United States, but also in China, which has OPEC today, or basically yesterday, today for us, cut their global demand for crude due to China? I just want to get your thoughts on that. I know that threw a lot of out there for you.
Yeah, and there's a lot there. I mean, because we've been in this freight recession now. There's some great follows out there on Twitter that cover this very carefully, right? And we've been in that freight recession now for almost a year, really since COVID, when Americans kind of shifted their appetite from retail to kind of experiences instead of buying more stuff. And so from that standpoint, you've seen, diesel demand has been really soft. And if the economy suddenly does, plunge into a recession, I think that's kind of what we're teetering on, right? If the Fed pulls off this so-called soft landing, we'll be in a better spot. But I think we're also on the brink of potentially seeing a more defined recession potentially, and freight and diesel is very much involved in that conversation, because everything moves on the rail or semis on roads. So there's a lot there that if we do tip into a recession, we're obviously going to see diesel demand plummeting. But we're also coming into the time of year. I mean, we're knocking on the doorstep of fall weather. We're here in summer still, but fall is dead ahead. And fall, you see heating oil demand shoot up as well as people start to fill their tanks, their heating oil tanks, especially in the Northeast. There's been a lot of conversions in those markets to using more natural gas in the last couple of years, but there's still heating oil consumption out there. So normally you see a seasonal low in diesel prices right around August. And then as you get into September, people start filling up their home heating oil tanks. And that could put a little bit more demand in the system. Keep in mind, too, you get close to the harvest season for agriculture. That's a big consumer of diesel fuel as well. So I think we may be getting to the kind of bottom in diesel for now. The seasonal rise will probably start over the next 6 to 8 weeks, but that seasonal rise could be muted by some of the economic duress, or if we're into a recession, that certainly could slow down that seasonal rise.
So I guess the question too is, do you forecast, using demand supply for gasoline, oil, and so on? Do you forecast looking forward into, is there possibly a recession ahead? Do you see that slowdown leading to a major economic slowdown to bring on something like a recession?
Yeah, initially in our 2024 fuel outlook, we had anticipated a slight increase in yearly demand from last year to this year, 2024. I think we've been a little bit off on that. I don't know that anyone's really been able to nail that down exactly, just because there's been so much talk about this soft landing and if the Fed can stick this or not. Right. There's been a lot of factors. I think overall demand this year will end up being quite a bit lower than last year. And I think it's because there's been more softness in the economy. I also think that COVID is still part of why gasoline demand this summer has been quite soft, is because a lot of people road tripped in 2022. Remember, that's when the Fed mask mandate was rescinded. People took to the roads after 2 years of lockdowns. Everyone was on the road. That's in part why gas prices hit $5 a gallon, is because there was insatiable demand. And then I think last summer, when prices were about $3.80, people were also road tripping that couldn't afford it in 2022. I think this year, though, we're seeing more Americans now travel abroad because a lot of those international COVID restrictions have been completely rescinded. So I think that's where a little bit of the softness in gasoline demand is coming from this year. I think next year it might normalize a bit. But also, and this also gets going into the political spectrum, is this could really change gasoline demand in the years ahead if we continue to see heavy incentives for things like electric vehicles or mild hybrids, right? That could definitely push more Americans to consider those options, which could accelerate any downturn in gasoline demand. But I think, kind of going back to your point, gasoline demand has been worrisome, but I think with all of the noise of, as I mentioned, the post-COVID behaviors kind of still shifting, and with the transition to EVs involved, it's tough to narrow that noise and to get any positive gauges on demand, right? Demand is still healthy enough where it doesn't necessarily show a sign of recession, but there's enough noise in the form of EV transitory data and a shift in consumer trends to be able to say, we're in a recession. I don't think we're there yet, but it's been a really, really soft year for gasoline demand. But again, looking at the EIA's monthlies, I think, Kevin, you mentioned too, the weekly data is fairly noisy. And the EIA just, I think, released revisions for May, and it showed a huge surge in gasoline demand to like 9.3 million barrels a day, a number that doesn't really jive with what our data expects. So don't want to get too much into the weeds, but there's also a big difference in methodologies. I think at the end of the day, gasoline demand's been really soft, but maybe not worrisome.
Yeah, I agree. We won't even travel down the EIA route, right? Like sometimes people get upset about it, but understand that we trade with the data that we have available, right? And so we have these massive revisions, but is the market already pricing that in? It's kind of similar to today's price action, right? So OPEC, I think the writing for the most part has been on the wall that they were going to reduce their global demand when it comes to the crude oil, just basically oil in general, in the back half of this year, just because we were not really hitting those targets. And so we had a small revision to the downside. And you would think that the market would sell off on that. But it seems like the market's already been pricing in that the fact that OPEC might have been a little bit off when it comes to the forecast. And that's kind of how I look at it. I mean, I think the market probably already had that built in over the last couple of weeks here. Export demand, though, for me, when it comes to, let's just say oil in general, which we export a lot, right? But also just the byproducts like gasoline. Is there a risk of resurging prices at a really healthy, not even going to say healthy, but a rapid pace to the upside if we do get this stimulus narrative really kind of getting going in China? What are the exposures that we have from external factors overseas to our prices here in the United States? And is there anything that's like a little bit of a concern for you when it comes to, let's say China, for whatever reason, boom, starts to ramp up and now they're starting to draw on our international stockpiles. Is that a concern for you right now? Or since it's just been so long, it's kind of, seeming like a little bit of a trickle when it comes to the China demand?
Yeah, China's been really interesting to your point there. They haven't really been using a whole lot of their refining capacity to export, right? Their export quotas have been pretty weak. It's like China doesn't want to step in and help the world too much. They've been doing that to some degree. I think the thing to your point, what keeps me up, I think as you see Ukraine emboldened to get inside of Russia and attack refineries, I think that's one thing that does keep me up. Russia has probably a very severely reduced ability to get the parts and the technical abilities in some cases to get those refineries back online. Now, Russia has said that even after many, I think over a dozen attacks by Ukraine on its refineries, that, it is back to exporting normal volumes. But I think, I think Ukraine attacking Russia's refineries is one of those wild cards that you just don't know how much damage they can do. And Russia is a major exporter on a normal day of some of these refined products. So, but I think even that wild card has been somewhat offset by an increase in refining capacity that's happened globally. You look at the Middle East, you've got new refineries there. China's got new refineries. We've got even, Dangote in Nigeria, they're still ramping up. So I think there is a little bit of margin for error here that even if there is a major drone attack, I think the global economy is slowing down. I think even if China does build up, I think there's still not enough momentum with the global economy that's going to derail or cause prices to shoot up here, given the fact that we're kind of, teetering on the possibility of an economic slowdown. But yeah, seeing Ukraine attack Russia's refineries, that's a big deal.
Yeah, it's a huge deal. And kind of going back to China too, I think it's understated how much refining infrastructure they actually do have in place and in-house, right? And then also the fact that they ramped up their imports and their stockpiles pretty much throughout COVID. They didn't stop. So now they have something that they can draw on. It's not gasoline related or oil related, but just to kind of piggyback off the Ukraine situation, that's another item that I'm kind of keeping my eye out on over the next couple of weeks for even natural gas flows, right? And knowing that they have this metering station that they've taken over, they are in close proximity to other refining operations. I think 30, 40 kilometers away from other operations that, as you're talking about on the oil and distillate side. What is interesting though with Russia is that they export finished products, but to the countries that they export, they don't seem to be huge drivers of draw on international demand. So there's kind of like you could have an impact if they stop exporting gasoline for whatever reason. You really don't see these massive spikes to the upside when it comes to gasoline, just because of this who their partners are when it comes to sales. But I'm right there with you. If we're talking about geopolitics here, we have Israel, Iran, Lebanon, Hezbollah, Hamas, you name it. There's probably a conflict there right now. Now, both Israel and Lebanon, they're not huge producers at all of energy products, but Iran is. And so it does appear that when we talked about this last week or even 2 weeks ago, that premium, the geopolitical risk premium in crude and in Brent was pretty cheap compared to the geopolitical risk that's out there. And now it seems like it's being priced in a little bit. Knowing that we have seen kind of these escalations and then this fading of geopolitical risk over the last year or so, right? Since October, right? Do you feel that from a trading aspect, fading this advance in crude is probably prudent? I know you might not be able to say yes or no, but what are your thought processes when you see this ramp up in geopolitical tensions and knowing that we faded them in the past? Do you think that this time could be different?
Well, I mean, I think diplomacy is at work right now, right? The U.S., we've been reading headlines that some major international powers are still trying to get Iran to respond in a way that won't further escalate the conflict. And it's because I think, it's interesting, all the things politically, the Biden administration came in and was obviously a lot more hostile to the oil sector. But now look at their attitude towards oil producing countries like Iran, right? They're entering the fray. They're trying to have, diplomacy work here. Even Venezuela, right? They said, hey, we'll free up sanctions if you produce oil, because they realize that the global market needs this oil. I mean, if Iran were to have a heavy-handed response, absolutely. I think you could very quickly see a risk premium being assessed by Wall Street, essentially. But there's a lot of, there are some bearish factors out in the market too. And I mean, that's what's taking over. You'd have to have a lot go wrong or to do a 180 for, I think, oil prices to explode. I mean, you mentioned the China slowdown. The U.S. is seeing a bit of a slowdown as well. And I think the broader global economy is seeing a bit of a slowdown. So I think that's why the geopolitical premium is just not where you might think it is, where you traditionally think it would be given what's happening right now. And I think Iran last time Israel launched drone attacks, right? They basically had a very big statement that, that essentially somewhat propaganda, right? That they made it sound like what their response was with a huge response, but in reality, it wasn't much of a response.
Yeah.
But I think the interesting thing here now is Israel has penetrated Iran's air defenses twice. And the interesting calculation here is Iran is obviously going to come out and say a lot of stuff, but knowing that Israel has penetrated their air defense twice may be a factor in why they may not want to have a heavy-handed response. So I think that goes into the calculation. Not only that, but a lot of diplomacy happening from, Middle Eastern countries that are saying slow down. But I think a lot would have to go wrong. Iran would have to have a really heavy-handed response. Then we'd have to see the economy suddenly rip-roaring, not just in China, but the U.S. And we're going into winter, which we tend to see a little bit less consumption as well, especially on the gasoline side. But it's not impossible. I mean, we're still in the midst of hurricane season, which is really active. If you get a major hurricane to knock out a couple of U.S. Refineries, there could be more of an impact to refined products. But, U.S. inventories have been drawing, the last 4 weeks or so. So, we're in kind of this precarious position, and we'll see if OPEC, they revise down their forecast. Is that going to mean that they're going to also push off their resumption of some of their output cuts, right? Are they going to push those off? Because I think they're supposed to be scaling back on some of those production cuts here in September. with their the forecast for lower consumption, will OPEC now also push out its resumption of some of those quotas?
Yeah. And that's actually very interesting because about an hour ago, Iran did say that they actually plan on increasing their barrels per day by 250,000. This is where it gets very interesting. And I have to leave it on this for myself because I do have to jump. What gets very interesting here for me, OPEC seems like I don't want to say it's holding on by a thread. I'm not going to be one of those doomsdayers that says, oh, OPEC, but we see cracks in this armor here. I mean, we've had members that have left over the last, 6 months or so because they're fed up. The smaller countries want to produce more because it's impacting their GDP. When a country relies 80, 85%, maybe even 90% on oil or on energy products in general, you get a little bit pissed off when you're not able to export. And we see Saudi Arabia. I think this is the fourth quarter of 4 quarters in a row of GDP losses, right? So at some point, do they come in just like they did in 2013, 2014 and say, you know what? Flood the market. We got to take this competition out because shale is kind of taking it over. And it's not even just shale. You're looking at other producers that are coming in. And so I think that is going to be the biggest dynamic that I'm going to focus on here moving forward is how does OPEC, because everybody is pricing in the fact that in October, they're going to make an adjustment, but they've already cut back a lot and prices really haven't escalated that much. How much can they really cut and not hurt themselves or not deteriorate or destroy the alliance? I think that's going to be very key. But I do have to jump, Patrick. It was a pleasure meeting you. Looking forward to watching the rest of the video. What I did want to say, just those that are watching, we're still in a very volatile market. So just be very, very cautious. The S&P 500 literally just dropped about 40 points in a matter of 3 minutes. And so this is just low liquidity markets across the board when you're looking at multiple asset classes. Be very nimble in this market. And Jason, I'll talk to you later. Patrick, I hope that you have a good rest of your day. And thank you for joining us. And I will see you all later.
Thanks. And Jason, I think Kevin had a really good point there. You know, where the cracks are starting to form in OPEC. I mean, the strategy hasn't worked. Right. And that's why you're starting to see the cracks. To Kevin's point about, you know, the bullet in the armor, you know, when is OPEC suddenly going to wake up like they did in late 2014 and change the game? This hasn't worked. A lot of disagreements. Nothing's changed, though. U.S. oil production continues to slowly go up. So, you know, I could see a valid argument that there's probably there's maybe more bearish risk to the price of oil than bullish at this point, because why are OPEC members going to stay on this bus if it hasn't produced any results? I think that's, you know, certainly something that could change, especially with Iran, you know, suggesting that it's going to increase production.
No, I completely agree because it's a thing Kevin and I have been talking about this for a while on here. We don't really have the most bullish outlook on anything oil related at the moment. It's mainly just geopolitical risk, and most of the time that doesn't turn into a structurally bullish market. So you know, I still think with you the risk could be to the downside, at least trend wise, but there is this massive upside risk that could happen just because of the geopolitical risk out there. So I think it's really interesting on two different angles, which is it's kind of a do nothing market as a trader, you know, like maybe the best answer is to do nothing, which is sometimes the famous shot to nowhere quote, you know, you sometimes the best thing to do is nothing, or put yourself in a position where you're kind of sitting on your hands. So now that Kevin's off, I wanted to ask you a couple things. So, you know, we do a lot of education on here, and so a lot of people like to hear about certain things. So I'm wondering, when you're forecasting the market and you're looking forward and you're trying to put together a thesis of, you know, the market can go up or down, or you're saying, you know, I mean, I hear you say all the time, hey, it can go down 30 cents for gasoline. And then usually you're right most of the time. So how do you put these things together? Do you use the app for forecasting? Do you use your own data for forecasting? How do you forecast these markets?
Probably like a laundry list answer, right? Where there's all these different factors. And if something changes at the last moment, right, you try and sleep on it a couple nights. I mean, putting a forecast out for 365 days in advance, you know, you hope that you're going to be accurate and you hope that your read on everything is accurate, but realizing that it doesn't take much to shift markets in a significant way, right? And so when we put this forecast together, get us in the mindset of where we are in December of 2023. There's a lot of things that we know exist already at that point, right? The Israel-Hamas conflict. And it's just, it's a lot of data. It's not so much our pricing data, simply because pricing data is reactive to things that are happening in the market. It's more like we need a market signal. So I certainly utilize gas buddy demand data to get a lead, to get a pulse, right, on how things are looking. In the post-COVID world, we've been monitoring when people are filling up, like what time they're using the Pay with Gas Buddy card to fill up. Are they going into work, right? Because a lot of stuff changed during COVID. And if some of those people are starting to go back to an office, that may be a sign of gasoline demand potentially rebounding. Instead of the work from home, companies have scaled back on that a bit. People usually have to go into office a couple days a week now. Thankfully, not me. But yeah, that a lot of that data we look at, just about everything. What people are buying? Are their tastes changing? Are they trying to, are they buying less Red Bull and more Monster? Are they trying to scale back their expenses? So there's a lot of these different triggers. And then the geopolitical one is just one that nobody can predict, right? And that's just knowing everything we do, reading as much analysis from people that are experts in, these relationships, just trying to get a pulse, and sticking to the middle, right? Because there's noise on both sides of things. There's people that might be doomsdayers. There's people that might be the complete opposite. And trying to read the situation and using data. We use a lot of data from the EIA as well to get a pulse, and I can't underscore as much for all the disagreements we have on what that data is supposed to mean. They do a terrific job in keeping track of, pipelines, infrastructure, everything that does matter to our forecasts. So a lot of it simply too is there's an element of hitting a dartboard, not from 10 feet or 20 feet away, but it feels like more from 2 miles away. And we take all of that and just, sleep on it a couple nights and try to come up with some safe assumptions, and realizing that there's always going to be wild cards, right? When we put our 2022 forecast, we highlighted that geopolitical tensions, there's always a wild card, and then Russia invades Ukraine. So, but yeah, it's kind of, you give it your best go, given all the data that you can intake, analyzing that data to see the strength of the economy, using other data sources as well, to try and get their special pulses. I remember back in the early days of the pandemic, remember when everyone was using like Google Maps and Apple Maps for mobility data and stuff like that. So the great thing about the world we live in is there's so much data out there that you can use and creating a forecast.
That it's interesting because it's the two things that I would say, which it's amazing the amount of data we have, and it's also terrible the amount of data we have all at the same time, because it's easy to get confused. But I think talking to experts like yourself, and being able to say like, hey, this is what I look at, this turns into a lot of people kind of being able to understand, hey, these are the things that might be more important than other things. So that's why I always love to talk about those things. And so we do have a question for you here, which is, how do you best guide through all the volatility in the commodity market? We'll just talk about the commodity market mainly.
Yeah, I mean, there's vicious cycles here, right? In the commodity markets, it tends to be really good, and then it tends to be really bad, and then that brings right there. It's been tough to find a balance, especially in commodities. Refining is no better example of that. It's very much a boom or bust cycle. And you have to be prepared for that. I think that there is a difference, though, I would say post-COVID, is that there's, instead of reckless spending on new production, there's been calculated spending. But I think that's also because of the political landscape in which people want to ditch fossil fuels, and they want to, go to electricity overnight, which has its own strengths and weaknesses. But how do you position for that? I think that's $1 million question. I don't know if you can, right? Some things are just going to be outside your control. And just realize that these cycles always exist, the bull and bear cycles, and hedge some of your bets, right? Don't be fully exposed on it. Don't run for the profit when everyone else is, right? Usually when everyone else is running for something, it might be smart to run away. Just like a week and a half ago when everyone was running for the exits on Wall Street, it's like, do I take that nest egg that I've been leaving there for these types of situations and put a little bit of it into the market? I think it's all about hedging your bets. And I think when it comes to the long term, right, because people look 5 and 10 years, does it make sense to make investments in liquid fuels right now? I think it does, but I think you also have to watch the political landscape really carefully, because I think, this presidential election, oil has been a focus for both political parties, maybe one more than another, right? The drill, baby, drill mantra. Well, that may be great for consumers at the pump, but that might be not so great for oil investors, right? If suddenly everyone can produce as much as they want, and that causes the price of oil to plummet, that probably isn't going to do really well in an investment. So I think, how do you weather it is try to put your political agendas aside and read the market for what it's worth. And, you might get in trouble listening to political party talk about how they're going to do things, and just, I mean, politicians will lie, and that happens on both sides, or they'll have great ideas and they never execute on them. Right. And that's important to remember too, that politicians don't control if I wake up tomorrow morning at 7 o'clock or if I breathe. Diversify, hedge, and be ready for a presidential election that may surprise you.
No, I love that, and thanks, Dave, for the question, and well said there. And so, getting to Andy has a question as well. So, and I'm glad this is cool because we get to have somebody like you on here to answer some of these questions that some people have out there. And Andy gave you a compliment at first. Great stuff, Patrick. Do you see any sectors like oil services, explorers, certain aspects of the market that look more bullish than others, and why?
I don't look too much into things like oil services. Again, like a lot of what I look at is refining and downstream. So I don't want to get too much into oil services and drilling. To say that, if restrictions are eased in the future, if we do see a Trump administration in the White House, I think they'll be much more friendly to the sector, which may be more unfriendly to profits and investors. I think refining. Look at it this way. The US, first world country, we're making the transition to EVs rather slowly, because even in a country as large as the US, or, as powerful as the US, it doesn't always make sense to have a battery or solar in the middle of Wyoming, right? I think that there's a lot that's been said about the transition to EVs, but I think there's going to be pushback. I think the technology is going to evolve a lot too, right? Look at battery technology. If Toyota has been working on, and I think other manufacturers have been working on, or LG, I should say, has been working on solid state batteries, you're going to wake up one day and suddenly that technology is going to suddenly really change the calculus here. So, and none of us really has a really good pulse on how quickly that technology is going to make it, into your driveway, into your garage. I think liquid fuels are going to be around as long as I live, quite easily, because third world countries may not have the investments. Now, if a China comes in and does like a road and belt initiative for EVs, those types of programs are really going to change the calculus too. But realize that there's going to be a lot of imbalances. However we move forward, the EV transition is really going to have an impact upstream and downstream on those sectors. If the US is trying to whittle itself off of fossil fuels, that's going to mean that oil services, refineries here in the US may be disadvantaged for a time. That's also a reason why refineries are much bigger in the Gulf Coast, because they have a lot more export markets. So you look for refineries that are ideally located the Gulf Coast, whether that's Louisiana or Texas, because one area that's really not building refineries right now is South America and Central America, and their populations are booming. So, there's a lot of potential in various portions of the up and downstream. Refineries in the Gulf states are just really well positioned to weather that kind of that transition. But oil services, again, like I said, I don't do much on the upstream. So I couldn't really give a great answer on the upstream. But I think wherever the EV transition, right, is probably the biggest threat to the oil industry. Look at companies like BP that have diversified into wind and solar. Don't really know how fast it's going to go, that transition, or if it slows down or speeds up. There's a lot of states, by the way, in countries that have been backing off their target dates for making a transition completely to EVs. So just look at that. I mean, there's a lot of politicians that want to do a lot of big things, and now they're finally realizing that it's going to be a tremendous challenge to do that quickly.
Yes, and these things just don't happen overnight. And I think, once again, like it's kind of the big thing with politics. What sounds good and what will
You're
get the
right.
most votes are the things they're going to say the most. And so you're going to hear these crazy numbers and crazy outlooks, and it's mainly just to get them back in office, and that's just about it. And yes, I wish it was all puppy dogs and rainbows, but it's just
Yep.
not in politics. So just pay attention to that thing, and I also agree right with you where these agenda 2030 and things like this, like we're not going to move there as quickly as people would like it to, so it could put some major pressure on that industry in both directions. I think it's going to be a
Yep.
very interesting market to kind of see how we shift, what happens, but really, like, I think a lot of people don't understand how many things oil is actually in. Oil being in tires, oil being in paints, oil,
Literally
EV.
everything in your office and in my office, right? Plastics. Like
Mhm.
literally, I look at my keyboard, my mouse, my microphone, my webcam. None of that happens without petroleum,
Yep.
right? And there's this gangbusters political movement to just get rid of it, and to say it's awful, but we don't have a good replacement for plastics. There's nothing more flexible, right? And
Mhm.
it's easy to come by. So it's kind of like people that say when there's a hurricane that hits a refinery, well, why didn't they prepare for that? You spend hundreds of millions of dollars for for zero point zero 0.01 of risk. It just doesn't make sense, and that's why moving away from plastics, there's not really any answers yet. And that's where a lot of these political movements get way too far ahead of themselves. And I found it really interesting, by the way, both the presidential candidates, to your point about them saying things to win votes, I think both of them have now mentioned not taxing tippable wages, which is really interesting because now there's like a race to the bottom of who can we promise tax cuts to get elected. And it's like, okay, if we're not generating revenue, if everything is going to be tax free, I think Trump mentioned not taxing Social Security benefits. Like, is there going to be tax revenue for a lot of these EV incentives that exist today?
Yes, and that's the truth. I mean, it's this constant thing that we're kind of all living through, and it's also interesting. And I wanted to get your opinion on this, and this is an interesting thing to talk about, which is you were talking earlier, and we were talking about the administration and what would happen if one of the, like, if Trump gets elected or if Harris gets elected and so on. But I thought it was kind of interesting, and I wonder your opinion on this. A lot of analysts were talking, and it's not the wrong thing, it's just the way market works. So a lot of analysts were talking in 2020, and they were saying things like, if Trump gets elected, you want to buy energy, you want to buy banks, and so on. And basically, if Biden gets elected, you want to buy tech and solar. Then Biden basically gets elected. We see this huge run in energy. So I'm wondering, what do you think about things like that? And because for me, like, it's just my thought that markets are very separate from reality sometimes. And that isn't a bad thing. But I wonder your opinion on it, because everybody's heard me talk about things like this a lot, but I'd love to hear your opinion on it.
I mean, to your point there, I mean, there's going to be sectors that the president wants more, whether that's a Democrat or Republican, right? Everyone's got their agenda,
Mhm.
and you've got to figure out where they're going to go with it. And that's the thing, is sometimes they say what their policy might be, and sometimes they don't. There was something really interesting I was going to mention that was in the tip of my tongue, and now I completely forgot about it. But I try not to be in either political camp too much
Mhm.
because, well, first of all, you can be blinded by an agenda or an allegiance, right? And you have to put emotion aside and look at it from a healthy perspective. And the middle of the road is kind of the answer for me, because there can be good ideas from both political sides of the spectrum. And yeah, when it comes to oil, right? One party can preach. I think right now we're kind of at one political party at the antithesis of the other. It's just completely the opposite. One party says this, the other party does that, and is that logical? Is that the conclusion that Americans want? Just one or the opposite of that? Or there's got to be some sense in the middle. Like, for example, it probably makes far more sense for me to have an EV here in Chicago, where there's infrastructure, where I sit idling in traffic, and there's probably really no reason to have an EV or a truck EV out in the middle of rural America, where there's really no infrastructure, right? Liquid fuels are probably the better bet there. But Yeah, circling back, there's so many different ways this election could go, and so many promises that I don't know would be fulfilled. It's been interesting, though. I will say, watching the Biden administration, who was, as I mentioned, very hostile to the oil sector, parading into the White House, canceling the Keystone, retracting the Anwar leases that had been put together at the last minute by the Trump administration. It is kind of funny, though, to me, the people that said, oh, those Anwar leases, that's such a huge deal to energy. Oil prices went through the roof because those leases. And it's like, those leases were like fly by night kind of thing. And nobody really wanted to drill in Alaska where you'd have to build all this infrastructure. But yeah, the promises are really interesting because Trump's mantra is to drill, baby, drill. The thing that's really interesting to me, though, all this economic talk, all the talk of interest rates and how the economy could be teetering on a recession. And there was a piece in the Wall Street Journal, and Trump has openly said it, that he would be potentially interested in having a determining factor or weighing in on interest rate and fiscal policy. And that was really fascinating and potentially somewhat dangerous to me, I want less things politicized and more for people that are experts like Jerome Powell and people that sit on the Federal Reserve. Those people know a lot more about the delicate nuances of what they're dealing with than a politically influenced president. So when I hear things like that, I mean, my thought is like, okay, who can win from that? What sectors are going to win from a president that suddenly, real estate might do really well, right, if interest rates get cut? But it gave me pause because it realizes that it seems like the country is becoming more politicized instead of like just this logical thinker of there's good answers on both sides. And I just have to think that that's going to, it's going to be an impact down the road. And it's getting harder and harder to predict what moves there might be by a president. The other thing too is Trump is cozying up with Elon Musk. It seems like, right. There's been a lot more work. I think even today, Trump is going to be doing a show on X. So does that change the calculus, right? If Trump is elected president, does he increase EV incentives to further bolster the case? Because I think a lot of people would agree Trump definitely, if you butter his bread, if you scratch his back, he'll scratch yours. And so that's interesting to me because even something like that can change the calculus. Will Trump, right? Because he was all about internal combustion engine vehicles. And if he's cozying up with Elon Musk, will that change the calculus? And I don't have the answer. I just think that's fascinating.
No, I agree, and I think that's what the thing is about. I saw somebody put a comment on our Twitter about this and saying like, "Here comes the Trump bashing," and it's like, no, we're trying to have a conversation. Number one, like if you're doing any sort of analysis and you're really stuck on one side or the other, you're probably not a very good analyst. Like that's just the truth of it. Like you can't be on one side or the other and be blinded by anything. We're trying to discuss the policies and what could happen going forward. So I really like that outlook, and I do think that's pretty fascinating as well because that could change the landscape completely.
And to your point, an analyst has to think about the implications from things that happen on both sides. It's not a bash of a presidential candidate. It's trying to analyze their policies, especially when it comes to oil, whether it's pro-oil or hostile to oil. As I mentioned, Biden was. You have to think about the impacts that those policies will have on your industry because that's gonna be behind your forecast. And if you can't see in an unbiased way both sides, you're going to be a lousy analyst.
Yes, and even if you could look at it and say even Biden being hostile to oil, meaning hostile to oil production, and then you got Trump actually drilling more, you could have also a bearish forecast for oil for Trump coming in and a bullish forecast for Biden. So I mean, there's all of these different things we have to always be weighing out and paying attention to. So Patrick, is there anything you would tell I always like to kind of talk to people about this. You first got into these markets, you're first trying to like analyze things, and at first we're all making as many mistakes as possible. What would you tell like someone who's first getting into these markets, first trying to understand where gasoline might be moving? What would you say to like your younger self or somebody who's just getting into this?
Yeah, I don't know. I've always tried to have an open mind, but it seems like there's a lot of folks that are more politically aligned. And so they analyze things that, they may not look at it from a total perspective. I've tried not to do that, but I think that there's something even I learn like new every day. Just have an open mind, and listen to the experts. They've been doing this for a really long time. Try to avoid your intuition of discounting people that disagree with you. I feel like that is way too common in America. Like, if my opinion's different than yours, well, listen and add that to your pile of knowledge and use that knowledge to form an opinion of your own. Because a lot of people have really good insight. And again, appreciate you having me on. There's a lot of other insight that may disagree with mine that's really good to listen to, right? When you're trying to learn, you're trying not to whittle down the amount of books of knowledge. You're trying to increase the amount of books on your shelves, the things you can read. Same thing with opinions. You want to listen to everyone's opinion, analyze things differently, look at things differently, because it enhances your own perspective. And I think that's what I would like to be, cognizant of, listening to more perspectives, because though I can disagree with them, having them, to define what is extreme and what is not, I think is really useful.
No, I do too, and I think you got to be very open-minded to do this well, and be able to listen to both sides. So that's a great point, great thing to end it on. So Patrick, want to thank you so much for coming on here. Everybody seemed to really enjoy it, so thank you so much again.
I'm glad they did, and thanks for having me. Really appreciate it, and all the folks that left comments out there. Thanks for having me.
Of course, please come out again, man. Thank
Will
you,
do.
and we'll talk soon.
Thanks.